Hi everybody, this is Thomas from Wynn Capital with the third quarter market summary. On the screen is all my contact info. Connect anytime if you have questions or comments. Before we get going, let's take a look at the S&P 500 for the last year. So now we've got a chart showing all 4 quarters so far of 2023, and the end of 2022 is over here. So we started the year rallying at the end of, we had a little bit of a rally at the end of 2022 after a negative year, and have gone up pretty consistently until the beginning of the third quarter. Now we're in a pretty steep decline of about 10% from the all-time, not from the all-time highs, from the recent highs. And the end of the third quarter is here, and what's happened in the fourth quarter so far. And I've called out the Hamas attack was on the 7th. Rallied for a couple days, but it's in a decline ever since. The next slide shows the market summary for all these asset classes for the third quarter, and just the third quarter. Everything down for the quarter, and we can see what the average returns are for all these categories in the best quarter and the worst quarter. Now we're looking at returns for the 1, 5, and 10-year periods. So for the 5 and 10-year periods, the returns are annualized, meaning returns for each year. And they're all positive across the board. As always, the longer you remain in the market and the longer you remain invested, the more likely you're going to have positive returns. This next slide has the headlines for the third quarter, and I've highlighted some of the more notable items. The Dow notches the longest win streak since 2017. So after a bad 2022, we started going up again. We had a great streak of winning months. Then mortgage rates started to go up, and oil started to go up, and the market started to decline. This next slide shows us the headlines for the 12-month period, so a longer period. And I've called out and highlighted a few of the news items, but I was kind of struck by the Silicon Valley Bank failure and the bank crisis that happened, about 8 months ago, and how that has receded from memory as a crisis that at the time had investors very scared, but of course the market has rallied since then. Now we're going to take a look at U.S. stocks, developed country stocks, and emerging market stocks, all the equities. And we're going to see a pattern from this first U.S. snapshot that everything was down for the quarter, and the least worst were small cap value, which is what we overweight in our portfolios. Not always a winner, obviously, but over time they outperform large growth, and so we tilt our portfolios. Not a great amount, but enough to capture what we call the dimensions of expected returns. So if we go to international, it's even more pronounced, where growth, which in the first part of the year just skyrocketed, now is correcting, and people are going to value, which is a little bit more conservative in most people's mind. So same thing, even more exaggerated in value stocks going up and growth stocks going down. This slide shows country returns with the U.S. in the middle of the pack, very close to the middle. You had some outliers on the downside, and you had some outliers on the upside. It's interesting to note that this doesn't happen in a vacuum, that Turkey and Egypt are having 61% and 36% inflation on their currencies year to date. So the buying power, the real returns, are tiny fractions, but because of inflation, they're showing huge growth. Next, we have real estate, or REITs, and they continue to have negative returns, and most likely due to high interest rates. We own REITs in our diversified portfolios, but concentrate most of our real estate investments in alts that provide stable income of between 6 and 8% per year on average, on an extremely consistent basis by quarter and by year. We have to note that only accredited investors with 1 million in liquid assets are able to invest in alts at this time. That might change in the future, but for now it's mostly larger clients that own those alts. Now we're taking a look at commodities, which even before, this is only goes up to 6:30 or no 9:30, the end of the third quarter, before the Hamas attack, oil was already up a lot in the last quarter, and it's up again this quarter. So, which is usually negative for, not always, but usually negative for the market. Now we're looking at fixed income, which if you look at the returns for the quarter, short duration investments like money markets and CDs had positive returns. Longer term durations of intermediate or long-term bonds had negative returns. When interest rates go up, bond prices and the stock and the capital gains falls, and vice versa. When rates go down, these will rally. So we've had another period of rates rising, and so longer bonds went down. We are very overweighted in short duration money markets and CDs, and I just started buying some longer term bonds, and we'll see how that goes. There's a lot of, we've been underweighted in bonds for many years when interest rates were low. Now that interest rates have gone up and up, I think it might be time to get back into long bonds. So I'm starting to allocate more money towards long bonds. This last slide is an article from Dimensional Fund Advisors. The point of the article is that outperformance of small cap value is volatile, and the only way to capture the outperformance is to maintain your investment for a long period. That's it for now. I hope you find this helpful, and if you have any questions or comments, you can reach out anytime. Thanks a lot. Bye-bye.